Two ways to value startups. What is the valuation of a company? Evaluating the value of a company is very complex. Not because the math is super hard, but because there are so many uncertain factors. In this video, I want to share with you two ways to value companies: discounted cash flow and relative valuation. Let's start with discounted cash flow. The math is actually really simple. The value of a company is all future cash flows of that company discounted to today. So let's say that a kid runs a lemonade stand. If the kid doesn't have any costs, if the stand is open 1 day a week on Saturdays and lemonade is sold for $10, so every week the kid gets $10 and can buy ice cream, candy, toys, or whatever kids buy these days. Now comes the question, what do you think the kid prefers? An ice cream today or an ice cream 1 year from now? Well, today. And it's the same thing for you. You want money today. So the cash flows from the company is discounted if they appear in the future. So $1 in 1 year is worth less than it is today, especially if that dollar is uncertain. So let's take a startup example. Facebook used to be a startup. They could, in the beginning of their days, see growth rate in the terms of users and how much time the user spent on the site. So these numbers can be somewhat extrapolated in the future, but the growth rate will probably not be linear. It is a lot easier to double the user base of a network of 100 people than it is to double the user base of a network of 10,000 people, or, doubling a user base of 1 billion. In any case, no one would have been able to predict exactly the growth rate that Facebook enjoyed from when it was a couple of 100 users to billions of users. It is just not possible for anyone to, with complete accuracy, predict that. So, if we go back to 2012, Facebook made an IPO with a valuation of $104 billion. Facebook has paid more than $44 billion in net income since then, not discounted. This is the value that potentially could be returned from Facebook to its shareholders. It is very hard to assess the cash flows of a company. The Facebook example is from 2012, and only after the evaluation we can evaluate if Facebook lived up to its earlier valuation in terms of revenue and profits. Another common valuation method that doesn't require predicting the future is relative valuation. In theory, the process is very easy. All the investor has to do is to find a company that is similar to the company they're trying to value and look at the valuation of that company. And in startups, a common way to solve the problem is to have some kind of standard valuation for a specific type of company. Like, this company is pre-revenue or this company has revenue. But there are problems with this method too. It is very hard to find comparable companies since every company is in some way unique. And also, this method kind of requires that the previous investors did their job and valuated the company in a correct way, right? Because the investors are basically basing the valuation on previous valuations. So this could pretty easily turn into like a circular argument. If you like this video, please like, comment, and/or subscribe. Thanks.